Thailand's political shock is colliding with a slowing economy, and the timing makes the risks compound just when earnings visibility fades. So the play here is patience, tighter sizing, and using SGD-traded Thai SDRs on SGX to control FX and access while policy dust settles. Adapted from my latest in-depth Substack deep dive, this video lays out the sequence, the sectors, and the Singapore First Playbook that keeps income steady while keeping left-tail risks contained. I'm Iggy from the Investing Iguana, covering ASEAN macro, SG investor strategy, and income frameworks that fit CPF, SRS, and SGX tools. So expect practical steps, not vibes. Here's the flow. Constitutional sacking and instability premium, growth slowdown mechanics, US tariffs and sector margins, tourism's lower ceiling, budget passage versus disbursement risk, set underperformance and what to do, SDR mechanics on SGX, the discipline playbook and sector heatmap, then the Singapore policy context and the final action path. Thailand's constitutional court removed Prime Minister Paetongtarn Shinawatra for ethics violations tied to a leaked call, triggering a scramble in parliament and caretaker governance, while a successor is chosen from the 2023 slate. The pattern is familiar. Electoral wins checked by institutional vetoes, which raises an instability premium because ministries pause, budgets stall, and agencies avoid bold moves during transitions. For markets, that uncertainty widens the equity risk premium and slows decision cycles that drive capex and public tenders. Hence, shorter foreign duration and weaker multiple support in Thai equities. Quick check. If a house dissolves or leadership selection drags, would any construction-linked cash flows arrive on time? That's the execution risk to price. Transition, and this lands just as growth momentum slips. Momentum cooled after a better start, consensus is converging toward low 2% growth as Q2 slumped and the second half faces weaker trade and slower tourism, with downgrades clustering sub 2% as execution risks build. The mechanism is simple. First half exports got front-loaded ahead of US tariffs. That support fades in H2, tourism decelerated, and public investment risks delay amid political transitions. So the base into 2026 is softer with less fiscal wiggle room. In the article's table, the step down is clear. Early strength gives way to sub-trend growth, pushing us toward defensive tilts and lower growth assumptions when valuing Thai cyclicals. Rhetorical cue. If top line slows and timing risk rises, should valuation models carry fatter discounts on near-term free cash flow? Yes, especially for export-heavy and construction-linked counters. A negotiated climb down puts a 19% US tariff on Thai exports, down from an initial 36%, but with a 40% transshipment penalty that blocks backdoor workarounds and raises compliance costs. The mechanism is blunt. Margins compress unless firms pass costs to US buyers or reroute supply chains. Differentiated electronics might share costs, but price-sensitive goods face volume or margin loss. In the visual summary, the darkest cells mark where pass-through is toughest and EBAT most exposed, so DCFs on tariff-sensitive names should take haircuts to near-term cash flows and a higher equity risk premium. Quick question. Would new capex go forward when pricing power is uncertain and compliance risk just rose? Most boards will delay until there's clarity, which caps optionality near term. Arrivals started strong but weakened in Q2, prompting a cut in the 2025 target from 37 million to 33 million, with China still the swing factor and occupancy slipping as momentum cooled. This hits airport operators, hotel REITs, and tourist-exposed consumer names via softer high-margin spend, while VAT and the services multiplier lose some punch as traffic normalizes lower. The table in the post flags a tempered path and higher volatility in AOT's traffic. Position sizing should reflect earnings convexity to monthly arrivals rather than hope for a straight-line rebound. Ask this. Would a tactical stake in tourism cyclicals make sense without hedging with defensives when the ceiling is lower and monthly prints are jumpy? Keep such stakes small and time-boxed. The 3.73 trillion baht budget is expected to pass, but disbursement timing is the real choke because agencies wait for political signals. Tenders slip, and multipliers arrive late during transitions. That delays support to construction, cement, and local services, pushing stimulus into the back end and risking a miss on the growth window if execution lags. For income strategies using SRS or aligning with CPF-OA style conservatism, favor utilities and consumer staples over capex-dependent cyclicals until first half 2026. Clarity on disbursement speed. Engagement queue. Is a posted budget the same as cash flowing? In Thailand's current context, price disbursement, not headlines. Thai equities have trailed regional peers as politics and tariffs lifted the equity risk premium and compressed PE while foreign funds shortened duration. But capitulation wastes opportunity. Liquidity via SGX-traded SDRs gives SGD settlement, smaller tickets, and cleaner access, so one can rotate using rallies into political headlines rather than hold illiquid lines in direct Thai accounts. Tactics. Use bounces on leadership news to trim exporters facing tariff pass-through risk and add domestic cash flow franchises with steady dividends on pullbacks. Prompt. If duration shrinks, which assets deserve capital? Those with predictable cash conversion and dividend cover, not headline beta. SGX SDRs let investors own receipts of Thai blue chips in SGD with local clearing and lower minimums, cutting cross-border brokerage, custody friction, and FX ticket costs. The shelf spans banks, telcos, energy, consumer, infrastructure, and healthcare, covering a large slice of the set 50, so it's possible to build small, diversified baskets without opening Thai accounts. Practically, this supports a barbell. Defensives for core income and SGD, plus bite-sized cyclicals for event-driven optionality, all rebalanced under SRS constraints with less FX drift. Question. If the macro is noisy and policy pace is uncertain, isn't it cleaner to manage size and FX at source? That's the point of SDRs in this cycle. In uncertain regimes, rules beat bravado. Wait for key political and budget signals, lean into staples, utilities, and stable banks, and keep exporters on a short leash until tariff rules settle. For existing holders, reinvest dividends, avoid averaging down on fierce spikes, and use SDRs to right-size entries with staged buys and clear stop losses to defend capital. The two big checkpoints to revisit risk are Parliament's leadership resolution and the first clear wave of budget disbursement. Those can be turning points for local beta. Mid-video plug. If all the charts, checklists, and the written playbook help, grab the full Substack post, link in the description below. Defensives first. Banks with strong deposit franchises and utilities with regulated buffers deliver steady income, even when the tape chops. Staples provide demand resilience and real pricing power in a slower growth lane. Cyclicals are for optional upside. Airports and retail if tourism stabilizes, electronics and materials underweight until tariff clarity improves and CapEx returns with confidence. The risk checklist guides tilts. Stay cautious in stalemates, favor staples, utilities if public spending slows, hedge tourism bets with income names, and keep cyclical positions small with event-based horizons. Q. If politics is a storm, which ships are seaworthy? Cash-rich, cash-generative, regulated, or dominant share names. CPF-OA and SRS do not allow buying pure Thai single-country stocks or funds directly. Indirect Thai exposure must come through approved regional or Asia vehicles, usually SGD-denominated and listed or approved in Singapore. Sensible setup. Use SGD-traded Thai SDRs or SGX-approved regional funds in cash portfolios, and keep CPF/SRS for diversified funds with a Thailand sleeve rather than a direct Thailand bet. It's not about MAS endorsing an asset class. It's about allocation limits, approved lists, and disciplined rebalancing rules that keep risk within guardrails through the cycle. Prompt. If policy guardrails exist, why fight them? Let them force diversification while cash accounts handle targeted Thai exposures. Verdict. Thailand should recover, but timing matters. Let leadership get sorted. Watch the budget cash actually hit projects, and wait for tariff enforcement norms before adding risk. Positioning. Keep Thai exposure modest. Anchor in defensives with SGD SDRs. Treat cyclicals as short-leash trades around catalysts. Reinvest dividends and schedule reviews after political and fiscal milestones to avoid left tails. SG nuance. Align cash portfolios with SDR baskets. Hold CPF/SRS to approved regional funds, and size positions to the volatility regime, not to the headline. Question to end. If the payoff is better after clarity and cash starts flowing, isn't patience the highest IRR trade here? That's the edge. Here are the main lessons. Instability, premium is real. Growth momentum softened. Tariffs compress margins. Tourism ceiling is lower. Budget disbursement is the choke. Set underperformed but rewards selectivity. SDRs reduce friction. And a rules-based barbell beats bold calls. You can take these lessons into a Singapore investing journey. Use SGD-based tools, respect policy rails, and let process protect capital while waiting for better entries. If the breakdown helped, like this video, share it with a friend who tracks ASEAN, and hit subscribe for more SG First strategy. For the full charts, checklists, and written playbook, grab the Substack post, link below, and consider the premium membership for early frameworks, watch lists, and model baskets aligned to CPF SRS constraints.